Hello, this is John Fercucci from Insurance News Net, and I'll be the administrator for today's webinar, Annuities Unleashed, What Lies Ahead. Moderating the webinar is John Hilton, Senior Editor at Insurance News Net. Our panel today includes Todd Taylor, Head of New York Life's retail annuities business, an industry leader with over $22 billion in 2022 sales. He's responsible for leading all aspects of one of the company's largest profit centers, including strategy, product development, marketing, and operations, as well as external sales and service. Also joining us today is Todd Giesing, Assistant Vice President of Annuity Research for LIMRA. Todd is responsible for LIMRA's U.S. and Canadian annuity research and benchmarking program. Please ask any questions in the questions pane during the discussion, and we'll get to as many as we can at the end. And with that, I'll turn it over to John Hilton.
Thank you, John, and thank you to everyone for joining us today. Certainly a lot of exciting things happening right now in the annuity world. Sales are not only breaking records, but smashing those records by a substantial amount. Very happy to have Todd here today. I'm going to do my best to try to keep these names straight, but I've either interviewed or seen these gentlemen present numerous times, and I can confirm that we have a wealth of knowledge with us today. So before we begin, John, I think you have a poll question for our audience. Take it away.
Yes. The first poll is, what is your role? All right. If everybody could just fill in the answer, give that a minute. All right, people are still answering. Give it another couple of seconds here. All right, let's take a look. So split pretty evenly at the top between financial advisors and insurance agent, distribution coming next with insurance company employees, and then finally financial company and support back office. So a nice grouping across the board.
Great. Thanks, John. Let's get into it. I'd like to start our discussion with a look at the sales numbers, and we need Todd G for that. So Todd, can you summarize where annuity sales are right now?
Absolutely. And thank you, John, for having us here today. When we think about annuity sales, for the longest time, we were kind of in a rut. Sales for individual annuities over the past 20 years, they've hung in a range between $200 and say $250 billion a year until 2022. We went up to nearly $313 billion in sales. And like John mentioned earlier, smashing through previous records, which was set all the way back in 2008 at $265 billion. Well, so what is driving sales in 2022 and even into the first quarter of 2023? The first thing we have to look at is the economic conditions. We had a unique set of economic conditions that occurred in 2022. When we think about that, we'll start with the equity markets. Equity markets had was the third worst year in the last 30 years of performance for the S&P 500. It was down nearly 20%. And typically when we see a downward momentum in equities, this pushes people to protection itself. Now, on top of the equity markets themselves, we also had interest rates that were rising. When we talk about interest rates, that's usually a great thing for individual annuities and for the insurance companies, as it allows them to raise their crediting rates on certain products or increase the payout rates for guaranteed income solutions as well through annuities itself. We saw all of that occur where the product value got better through the year because of the rising interest rates. But given this unique circumstance of downward momentum in equities plus rising interest rates, investors had limited places to hide. Typically, you would think about bond portfolios in a time of equity stress itself, but the rising interest rates hurt the valuations. So we saw product lines such as fixed rate deferred, registered index-linked annuities, and fixed indexed annuities, which all offer that protection, that downward protection, all have record sales in 2022 and driving the overall industry well over $300 billion for the year.
John, you're on mute.
My apologies. Great stuff, Todd. Let's bring in Todd Taylor here and hear from New York Life. Todd, we know New York Life is always near the top of the sales figures. Talk a little bit about what your agents and producers are seeing out in the annuity market right now.
Yeah, and thank you for having us, John. This is a great opportunity to connect with folks, and I'm honored to be here with other Todd, which is what I'm going to refer to him for the day. I think Todd's comments and what LIMRA has provided on this is spot on. I think from the agents and advisors we interact with, mostly what they're seeing from end consumers is a lot of uncertainty. Todd hit on this. Equity markets are volatile. Bonds are down for the first time in a generation. Inflation is at historical highs. And we've also got more Americans 5 or 10 years away from retirement. It's the peak of the baby boomer wave than ever before. And I think it's an incredibly challenging environment for folks to figure out how to, hit those last few years of their pre-retirement age or their first few years in retirement with sequence risk and longevity risk and a whole confluence of factors. So I think that the overarching story is that uncertainty is leading folks into exactly what, LIMRA has documented, this growth in protected accumulation solutions, items that provide some sort of growth with some sort of guarantee on that, giving people a chance to earn a return, but also feel protected. So that's really been the story of probably the last 12 or 15 months, and it's obviously continuing into the first half of this year. I will say, though, that one of the benefits of this is, while there's all this uncertainty and annuities are in the media and on people's minds to a greater degree, I do think the long-term value of annuities withstands any economic environment. There's a lot of benefits, that annuities provide that can't be efficiently replicated by other asset classes. Use the example of lifetime income. It's very hard to do that just using traditional assets and produce anywhere as near as much safe income as you can get with an annuity. So I think this environment has the knock-on benefit of bringing annuities into the conversation, and hopefully they will stay there in the future as well. And I think one thing that we've spent a lot of time on that arena is there's a lot of behavioral benefits to annuities, in addition to just the pure quantitative benefits. The peace of mind that an annuity can provide often helps people confidently spend more in retirement. It helps them hold more equity in retirement, and it kind of insulates them from making, rash behavioral decisions. So I think a lot of that is coming to the forefront in this environment.
Yeah, that's a great overview from the both of you. I'd like to dig a little bit further into these sales numbers with you, Todd G. You talked a little bit about what this flight to safety that we hear about, and I've used that phrase quite a lot myself, but how much does what is happening now and what has been happening remind you of the 2008-2009 period and that flight to safety, and are the products better now, able to meet that need? And a little bit of a general question there, but can you talk a little bit about that?
Oh, certainly. We've done some look backs, right, at times where there's been some equity stress and economic stress, particularly the Great Recession, but also the tech bubble back in the early 2000s. During those periods, we also saw significant spikes similar to what we're seeing in 2022 and into the start of 2023 for products such as fixed rate deferred. What's happening today that we didn't see back in 2008 and 2009 is that it's growing exponentially because of interest rates rising. So when we think about fixed rate deferred products, right, simple rate for term for a majority of these products themselves, average crediting rates for 3-year, 5-year, and 7-year contracts, all of those are over 4%. We haven't seen numbers like that since the financial crisis. So this is giving the investors the opportunity to find that protection in this period of time where equities are shaky, but at the same time, get a lucrative rate of return. We're seeing similar scenarios for fixed indexed annuities as well, where crediting cap rates at some products are over 10%. So highly lucrative for the individual that's looking for the growth potential, but also the protection, whether it's short-term or even longer term within those product lineups themselves. During the financial crisis, we didn't have registered index linked annuities or RILAs out there. Those established in 2010 itself. And those products have done extremely well. Basically, from the pandemic on, we've seen the sales jump up and maintain themselves during this period. Again, just showing the value of the balance of protection and growth that individuals are looking for in their portfolio. And like Todd mentioned earlier, the demographics are on our side. A majority of annuity buyers are between the ages of 56 and 70. So they're buying in that retirement red zone that Todd mentioned, a few years before, right, entering traditional retirement ages, and either putting that guaranteed protection on a portion of their assets, or looking at guaranteed income solutions to supplement their income as they enter retirement.
Sure. Okay. When you see market demand change like this, Todd Taylor, how quickly are you able to adapt and offer your producers the right products to market? Because now, coming out of the recent earnings season, I noticed a lot of insurers that were slow to adapt. Not going to mention any names, but they're suffering now through some tough quarters. So, I mean, how important is it for New York Life to be able to adapt quickly?
Yeah, no, it's a great question. And I wish I could say, like, we just, we sort of predicted everything and we knew we were in the right place at the right time. But one of the longstanding sort of foundational strategies we've taken as an annuity business at New York Life is we aim to have one of the broadest product lineups in the industry. And one of the reasons we do that is so that we don't have to try to time different environments. So Todd mentioned some of the products that are in favor, and there's also some products that are perhaps out of favor in this environment. We aim to have a pretty even mix of production and to have this product lineup across a whole bunch of different categories so that we can be prepared for pretty much any environment. We do that for a couple of reasons. Obviously, we want to insulate ourselves in terms of the continuing to be a leading producer of annuities across the industry in different environments. We also do it. We have a large career agency system. We want our agents to be able to offer different types of solutions to nearly any client they can possibly face. And so that's one of the reasons we do it. And the other is economic. We try to mix our revenue streams between spread-based businesses and fee-based businesses so that we're able to insulate our earnings over time as well. So that's generally how we're able, to your question, John, stay in market and be prepared for different environments. I will say the other thing, and I think the reference to 2008 in your question to Todd is excellent. We're reminded, and I constantly remind folks that, the rate is important on what you're able to offer on these products, but so is the rating. New York Life is a AAA rated insurer. We've got the highest ratings of any awarded to any life insurer in the country. And people are reminded of that when, crises happen. So in 2008, we saw this flight to quality, a lot of business coming in our doors. We saw the same last year. And so over time, we consistently try to compete on the value of that financial strength. And we also compete on the value of being able to actually service and process the business. That's the other thing that happened in the industry last year is this massive influx. We had to be quite nimble as insurers in terms of being able to pivot resources to help process this business. And a lot of insurers are still trying to catch up from this influx of business. And that's something we've prided ourselves on, is our ability to handle big swings in volume. And it's one of the reasons we rose, per LIMRA's rankings to the top of the industry last year was a combination of product set, AAA rating, and also the ability to get the stuff in the door.
Mm-hmm. Okay. Now, not all annuity products are selling the same. So I want to get into a couple of product categories that were spotlighted at the recent LIMRA Life and Annuity Conference in April. Now, Todd G., you talked a little bit about RILAs, but how is this recent sales star doing now that annuity rates are rising, and what does the future look like for RILAs? Definitely, yes. So when we think about RILAs, obviously the hot topic here over the past few years,
especially considering the growth pattern we've seen. We've seen more carriers that have entered this space with RILA products, creating innovation and competition, which is obviously a good thing. But what we've seen in 2022 is we saw sales that leveled off on a quarter by quarter basis. They were hanging around $10 to $11 billion a quarter during last year, and same pattern as we start the first quarter here of 2023. It's still record sales. I want to be clear, we did see the growth continue in 2022, but the growth rate slowed down from the prior years. What we think is happening here is the dynamic of interest rates. We had interest rates that obviously rose very quickly in 2022 with that 10-year treasury peaking over 4% in the year itself. And that brought some of the risk-free products, right? The products that have full principal protection, such as fixed rate deferred and fixed indexed annuities, to those lucrative crediting rates that I mentioned earlier on that. So we feel that a portion of the potential RILA business made the decision to go into a fixed rate deferred or fixed indexed annuity given the environment itself. As we look forward, we do expect RILA growth to continue. If interest rates do pull back, we do expect that could be the potential for RILA growth to rebound. And then also equity markets smoothing out as well will help RILA markets, as it does have some loss potential for the investor within the product set itself.
Okay. And you yourself were part of a very good panel discussion on VAs. Variable annuities were once the star, but have been down for several years. And I think LIMRA recorded sales at their lowest since 1995. So, but I wouldn't say you're bullish on the return of VAs, but you are predicting a slight reversal. So tell us a little bit about that.
Sure. Yes. Traditional VAs obviously had their challenges in 2022. Sales were hampered because of the equity markets and the downward pressure on equity markets itself. And this is very common. Again, we can go back to those other periods, such as the financial crisis in 2008 and 2009 and the tech bubble, and see a similar pattern where traditional VAs dropped during those periods itself. But like you said, we don't think this is going to be a sustained downward pressure on the traditional VA market, that we should see a rebound. It typically happens fairly quickly too. It only takes a quarter or two of growth within equity markets to have individuals turn around and their investors look at products such as traditional VAs. Traditional VAs, they come in a couple of flavors and variations. So we'll have products with and without a guaranteed living benefit. We feel the segment with the guaranteed living benefit has potential, especially as more Americans enter retirement without the backstop of a corporate pension. So they'll be looking, we feel the demand for guaranteed income will grow, and product sets such as traditional VAs with a guaranteed living benefit offer the flexibility for guaranteed income for an individual that's entering retirement itself. We also have the subset of products that are without a guaranteed living benefit, and many times these are utilized for tax deferral as well. So if there is, there's one catalyst that could happen, and that would come out of Washington. If there's any tax law changes, that could bring tax deferral benefits back more into favor, and products such as traditional variable annuities will have the ability for investors to choose a portfolio of equities and stocks and numerous options within the sub-accounts to invest with that tax deferral itself. So we do have the product category rebounding as we move forward. We do think that there will be continued challenges in 2023, just as equity markets will still be a little bit shaky. But as we get back into a growth pattern with the equity markets, we do expect growth from 2024 and beyond. Okay,
good. Now, New York Life finished 10th in VA sales in 2022, Todd Taylor. So your company is selling many more fixed products, but talk about your approach to the VA market, if you will.
Yeah, and I want to emphasize in response to Todd's comment, I do think there's a lot of cyclicality. It's sort of you get it kind of this human nature thing. The irony here is that folks, as a result of sort of shifting away from VAs into fixed products when markets decline, or ironically, buying high and selling low. It's like this sort of the opposite of what economic theory tells us people should do. So I agree with him that I think some of this is cyclical, and it gets at some of your question. John, I mentioned we aim for a relatively even mix of production that ebbs and flows in terms of the economic environment. And that's one of the reasons we're, slightly more overweight in fixed annuities. But to your question more specifically, our overarching approach on product development is really aimed at simplicity. I mentioned we want to compete on, our financial strength. We want to compete on our ability to process the business. But one thing we focus on with variable annuities in particular is that simplicity story. We want to be able to explain the benefits to an end consumer. If we can't do that, we don't think we're being effective. And I will share, the simplicity we're aiming for doesn't mean, we can't add real material benefits. Like complexity doesn't always make the benefits richer or better. And an example of this, I think I'd share just to kind of illustrate what I said earlier, the kind of long-term and behavioral value of annuities more broadly. A significant share of our variable annuities come with a, plain old guaranteed minimum accumulation benefit rider, just basically a, guarantee over 10 years or 12 years, you get your money back or you get some incremental return on that. Very simple story, basically a put option on the market. Now, that may or may not pay off in 10 years. You've got the guarantee of New York Life to say, 10 or 12 years, we'll pay that for you in the event the market's down. But what we've discovered is the presence of that guarantee actually changes people's behavior. So we did this study looking at people who had the GMAB versus those who didn't, all else equal, same age, same gender, same affluence, et cetera, et cetera. Those with the GMAB, the guarantee from the insurance company, held something like 10 or 15% more equity in their accounts than those who didn't. Now, as you guys know, 10 or 15% more equity over the long run, you capture that equity risk premium. It actually turns out that it effectively pays for the rider. If you hold on to that over the long run, you earn something like, 80, 90 more basis points in return in the long run. Now, so the guarantee may or may not pay off. They're still on the hook. We're still on the hook for that. It's going to guarantee the consumer. But the real benefit of it is the peace of mind is giving those consumers confidence to stay in the market. We've also discovered that people who have this rider sell half as much in sort of panic moments like March of 2020, half as likely to sell out of it. And I don't mean to make this just an advertisement for our GMAB rider. I think this is true of insurance in general. It's really that peace of mind. It's not zero sum with the insurance company because people don't all act optimally. They sell out of the market. They do all kinds of things that are suboptimal. And so the value of the guarantee is it helps them confidently do things that are sort of better financial decisions. And I think this is a great example of it. And again, one of the things we aim with our product development is find a simple story that'll help people make wiser decisions, with their investments. So I think it's a statement on the insurance industry in total of how that we add value with some of our products.
Oh yeah, really good stuff, Todd. We're just a hair ahead of schedule, so I'm going to sneak another one in here before we take a break. I'm always interested in fee-based annuities and how that trend is progressing. So I'll ask you both. What is the future for fee-based annuities? Todd G, go ahead.
Sure. Yes, this has been quite a hot topic over the last 3 to 4 years about fee-based annuities. And I look at the fee-based market in 2 segments. We'll have the duly registered individuals, broker-dealers, and then we'll have the RIA space, right? And there are 2 different audiences that the insurance companies are looking at to capture some share with annuity products itself. I always say it's the process, not the product, that's slowing us down itself, that there's operational hurdles that we have to address as an industry to get fee-based more mainstream out with the distributors out there. And this is everything, right? When we think about operational, from billing to products that can have the fees pulled out of them, there's all these different layers of things that have to be tackled from an industry standard. There's companies that are out there that are working on this. So we are seeing some gains in momentum with fee-based sales themselves. They are slowly moving up. Obviously, in 2022, we had the dynamic of the down equity markets, which hampered, obviously, traditional VA sales, whether commission-based or fee-based on those product lines itself. But when you look at the FINRA registrations, you can see the trend, and it's very obvious that the advisors are moving more towards either being duly registered or straight to the RIA space. So I think there's a lot of potential and opportunity. The interesting part is when is it going to go? I think we'll see this slow growth and momentum continue with fee-based products moving forward. And once we get a significant amount of the operational issues in there, or a third-party tech firm to, fix the operational issues with the relationship with a broker-dealer and an insurance company, then we could see a catalyst for very strong growth. When that'll occur, we don't know at this point in time.
Mm-hmm. I'll second nearly everything Todd said. I think his comment that this is a process, not a product issue, I think is spot on. He looks at this across the industry, but I'll share an anecdote just from New York Life. We introduced a fee-based variable annuity into our career system for our duly registered IRRs last year. In that example, we controlled the ecosystem. So we were able to, connect the plumbing, connect it to proposals, tie the whole process together to make it seamless for our advisors. We became, I think, and Todd would know these numbers, the 7th or 8th or 6th largest fee-based annuity writer in like 6 months. And that's not because we have some amazingly special story in this case. It's just because we had that process. That was part of our product development. It wasn't a matter of just throwing a new product over the wall. We had to integrate the whole thing into the system. And so I'm with Todd that I think it's going to take the opportunity to do that at scale across the rest of the industry and in places where the product manufacturers don't control. So we were successful in a world where we had a large stake in the control of that ecosystem. But I agree that it's going to take more procedural improvements for outside distribution to make this work.
Okay, good. All right, gonna bring John back in, and I think we have another really good poll question.
Yep, we do have another poll question. Here we go. What annuity products are selling best in your, it should say world, sorry about that. What annuity products are selling, it does, best in your world. Give folks a few seconds to fill that out. All right, I think people are just about done. Take a look. See, the fixed rates are at the top here. Let me just ask Todd, any comment on the results we're seeing here? Is this what is expected pretty much? Here we go.
I'd closed the window, so I missed it. But yeah, I think these line up pretty well with, the story of what's growing in the industry. Todd hit on this at the beginning, fixed rate products, indexed annuities, those are driving a lot of the growth.
Okay.
Yes, agreed with that too. We're looking closely at that fixed rate deferred market. We are expecting it to slow down at some point. We don't think the volumes that we're seeing now are sustainable long-term. We did over $40 billion in the first quarter alone, which is mind-blowing, considering going back a decade ago, we were lucky to get, that much in a year itself. So I think, we'll start to see it level off. We did see obviously some rates. The rates are starting to level off as interest rates have pulled back slightly here early in the year, but still very attractive for investors given the overall economic dynamics.
Okay, great.
Yeah, and John, I don't know if I'm skipping out a turn here, but there was a question that was raised in the question bar around the percentage of replacements, and I think it ties in nicely here. Todd may have the numbers across the industry, but we certainly have replaced a fair amount of business. It's natural as rates rise. A lot of stuff that was last written in 2008, 2009, 2010 with a rich guarantee is now finally getting a chance to move to a higher rate. But the good news, I think, for the industry is we're definitely growing fixed deferred and fixed index annuity sales in addition to just replacements. We looked this up in our own block. Replacements have historically been maybe 30 or 40% of the fixed category. But we added 10% to our AUM in like 6 months last year. Basically, the net of everything going out the door, we added 10% to our fixed deferred annuity in force. And so that means there's a lot of new money coming into that story in addition to, the replacements.
Oh, very good. Yeah, this might be a good place to just talk about. Todd, you and I have spoken a few times about the short-term contracts, and those are going to be coming due. Maybe you can explain this better than I can.
Sure. And just to spin off what Todd mentioned earlier about his block of business, we are not seeing a significant amount of activity to indicate that the fixed rate deferred sales frenzy that's occurring now is replacements of existing contracts. Sales went up $60 billion last year from the prior year, and full surrenders only went up $8 billion. So, we have to surrender a contract to exchange it. So all indications are, like Todd mentioned about his business, is that the money flowing into the annuity space is coming from outside sources, whether it's equity and bond portfolios and other products that are coming in for the protection that they can't find elsewhere. When you mentioned, John, is interesting because this is something too about our forecast, right? Where's this money going to go in the next 3 to 5 years, right? Over 90% of the contracts that have been sold for fixed rate deferred are 5 years or less for a duration. So a majority of this money is going to start coming due in 2025 through 2027. That money will have to go somewhere, whether it's a new fixed rate deferred contract or into another annuity product like fixed index annuity or RILA if somebody's looking for more growth potential, or the individual's needs may have changed and they may be looking for guaranteed income solutions at that point. We do expect, because the banks sell a lot of the fixed rate deferred business, that it's a more conservative investor in that type of environment, that we would see a significant amount coming back into fixed rate deferred. But it'll be an interesting dynamic to see what the rate environment is in 2025 versus today. Our assumptions in our forecast do have rates going down, where we have a 10-year treasury under 3% in 2025. So we may see more of that transition to products like FIAs and RILAs for the upside potential, but still having some protection on the product.
Okay, good stuff here. We're jumping around a little bit, but the sales stuff is really interesting. I know we're going to come back to it, but I do want to touch a little on technology here. My girlfriend's in the health insurance field, and she's right now in New York City. There's an InsurTech conference at the Javits Center. I hear about it more and more at every conference. Technology. Todd T, I mean, what are you doing at New York Life to help you guys process annuity apps a little quicker?
Absolutely. And I think this is, I've been in the industry quite a while, and I'll say that conversations on processing applications, I've heard more of that from my peers at other leading insurance companies in the last 6 months than I heard in the prior 6 years combined. Last year was a wake-up call that customer service and advisor experience is far more important than just like kind of an afterthought that you have to accommodate. This is how our industry is going to move forward, and we have to be, massively improving, customer and advisor experience. At New York Life, we focused a lot in the last few years on this. I think I'd break it down into 3 buckets. The process element you mentioned, John, flexibility, to be able to handle varying amounts of business, and transparency, just in terms of where we are on these things. So procedurally, we've built some, I would describe them as piping with a lot of our distribution partners to efficiently pass information back and forth, to cut down on, not in good order, NIGO applications, share information and money going back at a much faster rate of speed. We have to continue to do this, but we've built this piping with key distribution partners to be able to process it faster and really to be able to handle that changes in volume. In terms of flexibility, this is critical for any service operation, but we've made a lot of investments in infrastructure and workforce management tools to be able to say, hey, when the annuity new business is up by 50, 60, 70%, we've got to be able to pivot resources over to handle that business from other areas, from our claims team, from our call center, from our in-force team. And I think we've done a quite nice job of being able to do that very nimbly. It took investments over time to be able to do that, cross-training, et cetera, to be able to handle that. And then I think the item we're working on the most recently is really around transparency. A lot of what bothered advisors last year was they put an application in for an annuity, you get this attractive rate, and then they don't hear anything for days, sometimes weeks, sometimes months. And what that does is it actually exacerbates the problem, because it's totally natural if you don't hear what's going on, you call in and try to figure out where your application is, which of course leads to even more work, which slows down the process further. So we've spent a lot of time, one, creating pipelines where top producers can call in and reach our folks much quicker. But most importantly, as with others in the industry, we're trying to create near real-time transparency on where an application is in the process, how you have to resolve a NIGO, how you can accelerate the movement of money. And I think that's made a big difference. It gives people confidence that this business is going to be processed, even as while a whole industry, we've got to move faster and be able to process business much more like, the mutual fund or the wealth management business. That's kind of the long-term direction we need to go.
Sure. I'm gonna sneak in a little follow-up there, because I frequently write about the call it people power situation in the industry. I mean, are you seeing a talent shortage? Is that an issue?
Yeah, I think we all had a pretty big dislocation. I think all, up and down, organizations in the wake of COVID. People had massive different, changes in how they thought about work, where they wanted to live, whether they wanted to show up in an office, et cetera. So I think there was a big dislocation across all industries, in 2020, 2021. And certainly we felt that just as people rethought their careers. But it is true that we also have to, while we may be through a lot of that, particularly in customer service roles, we need to remember that, these are folks we need to invest in. We want to, it's so much more valuable to retain an employee than hiring a new one. And so we spent a lot of time focused on professional development, being able to rotate and develop people across the enterprise. We have this great history of bringing people in as customer service reps, moving them into sales roles, moving them into marketing roles, moving them into product roles. And making it more of a career than a job. So I won't say we've solved that perfectly, but I think a lot of folks are working through that, John, to your point, to make sure we're retaining and developing employees as we go along, because it is so critical to our success.
Sure. And of course, I'd be remiss if I didn't touch on the regulation as a disruption to the industry. It's something I cover quite a lot at the state, federal, and SEC levels. Todd G, I mean, just touch a little bit generically on how regulation might impact annuities going forward.
Absolutely. And regulatory changes, require not only the insurance company, but the distributors obviously to be in compliance with these. And sometimes it requires significant change, right? And that change is going to get prioritized over anything else if they have to do that. We saw that clearly with the DOL fiduciary rule, which was proposed in 2015, enacted in 2017, and then retracted in 2018. I think a lot of the work that was done for the DOL fiduciary rule during that period has made it easier with future regulations that have come out. We've obviously seen the SEC best interest rule that's been implemented in the industry. And again, because a lot of the work was done for the DOL fiduciary rule, that meant it was less onerous for the insurance companies and the distributors at that point. We're seeing and continuing to see, obviously, states that are regulating their annuity business and coming out with either best interest rules or privacy rules. And I think this is one of the potential challenges for the industry itself. Is if the states are not aligned with the regulation, or if there's variances from state to state, it's going to create challenges for insurance companies that may have 10, 15, 20 different rules to play by, as well as the distributors. So I think, looking at the regulation and having the states mostly aligned would be a positive for the industry, but if we start to see some variance from state to state and having, all these different rules could create the challenges for the industry itself.
Sure. Okay. I want to pivot back to sales now and look at what you're projecting, Todd, at LIMRA. Now, you touched on this a little bit here and there, so we'll just kind of summarize and put it all in one spot here. And we did get a question in the chat about the projected number for replacements. So looking out, I think you're out to 2028, I believe. So tell us what the annuity projections are.
Sure. We just published our updated forecast, which covers 2023 through 2027. So a 5-year look. And we have the momentum that we had in 2022 continuing. So 2023, we think it's going to look a lot similar to 2022. We'll still have some uneasiness in the equity markets. And then the different dynamic we're going to see in 2023 is interest rates that are starting to retract itself. So our assumptions have interest rates coming back down to, again, under 3% on the 10-year treasury over the next few years. And then it has equity markets calming in 2024 and then going back into a growth pattern from 2024 through 2027. What I think we're going to see is we're going to see sales volumes for the overall industry in 2023, very similar to what we saw in 2022, but we're going to start to see some of the product shifts. All right, we're going to see fixed rate deferred that will slow down as interest rates come down. And then as we get into a period where the equity markets start coming back, we expect even a stronger drop in fixed rate deferred in 2024. But as we talked about, we have that replacement dynamic that's going to occur in 2025 and beyond that will have a lot of potential money in motion at that point in time. And we do think that money, like I mentioned earlier, is going to fan out. Some of it will stay with fixed rate deferred products, but some of the money is going to go to other solutions or even leave the annuity market entirely and go into different investment options itself. So we do have in 2024 industry sales that will be slightly less, but still very strong historically. As I mentioned at the beginning, we were kind of in this $200 to $250 billion range for sales over a 20-year period. We feel that sales could be eclipsing $300 billion over the next 5 years. And as we start to get equity markets calming and the demographic shift that we're continuing to see in the United States, we'll have more potential customers, and that'll fuel sales through 2027, which will be well north of $300 billion in those years.
That sounds good for sure. At New York Life, Todd T., I mean, what do you see as the biggest challenges for your continued annuity sales dominance over the next decade?
Yeah, I'll say this. I mean, we were top of the industry last year. It's not an explicit goal for us. We've been a consistent top 5 writer of annuities, and we, have every intention of staying in that vicinity, and I feel good about that. But I do think, and this kind of gets at some of Todd's comments around the longer term trends, I think there are a couple areas as an industry that, we need to focus on and to solve to make sure this moment of attention on annuities isn't fleeting. Like we've proved sort of the value of these products in the last year. But I think in a couple camps, the first is we've got to continue to educate folks on the unique value of annuities. I mentioned there's things you can do with annuities you can't easily replicate with other products. There's also a number of behavioral benefits. We've got to get out and tell that story to advisors, including those who haven't been selling annuities historically. I got into this business basically out of an interest in doing kind of dorky retirement planning. And I find that stuff fascinating, but we've got to be able to highlight the value of our products in that world so that, in 5 or 10 years, we've got way more advisors offering the products. New York Life has taken a strong bet that, financial advice in the long run will continue to be through humans. Like, it's still person to person financial advice, but we want to make sure annuities are included in that conversation. And the other item, and just to underscore what I said earlier, we've got to fix procedurally the way that annuities are distributed. We have, whether, I said New York Life wants to compete on our ability to service these products, and I think we stand up very well versus our competitors, but everyone has room to go to line up versus mutual funds or wealth management. So we've got to make investments to make the data, the process, the integration of our products into a broader financial planning conversation much smoother, so that we don't lose systematically many consumers and advisors from the population. I don't have the exact numbers, but there's high double-digit trillions of dollars out there in terms of personal financial assets in the country. And so Todd's talking about whether we're at 200 or $300 billion annually. I'd like that number to start with a T, not with a B. And I think we can get there with enough sort of broader adoption of our products and making them feel much more integrated into a broader financial plan. But that's something that it's not New York Life specific. That's something we got to work on as an industry.
Sure. Okay. I want to remind folks to get those questions in. We're going to wrap it up here shortly and do those audience questions. But Todd Taylor, I'm going to sneak another one in here. I have seen a lot of news lately. I guess there's news all the time about new products, products being withdrawn, new writers. Anything to preview from New York Life for us coming up in new product area?
Yeah, I mean, I'll highlight one. We recently made changes to, or recently introduced a product that kind of is a hybrid between an indexed annuity and a variable annuity. So, we've seen a lot of this interest in index products, and I think Todd properly highlighted these are being positioned as really fixed deferred alternatives or CD alternative. It's an indexed annuity is really just a FDA with a little bit of a kicker. It's not a full variable product. We introduced a product last year, and we're continuing to make enhancements on it called Index Flex, which is an indexed annuity basically in a variable annuity wrapper. And one of the benefits of that is it enables you over time to reallocate between indexed and variable sleeves, all in that tax deferred shelter. So you're not paying taxes moving things across products. And also, given a 5 or 7 year surrender charge period, you're able to move the money without having to face surrender charges. So that's something we've focused on. It competes really in the RILA category. It's an ability to kind of adjust your risk level. But it's a pretty unique product that we've had a lot of success with over the course of the last year.
Okay, very good. I'd like to bring John back in, and I think we do have some of those audience questions.
Yeah, let me just follow up a little bit, Todd Taylor. Somebody asks about fixed indexed annuities. What innovations do you see coming to this product in the future? And you kind of just answered that, but is there anything else we should be looking at in terms of innovation?
Yeah, it's a great question. I mean, I think, this was highlighted earlier, but a lot of the growth of RILAs and indexed annuities was in response to this low interest rate environment. So, fundamentally what you're doing is you're getting a little bit of upside over a fixed deferred annuity. And that's worth a lot when those fixed deferred annuities are crediting 1 or 1.5, now they're crediting 4. And I think that drives a lot of the dynamics between RILAs and indexed annuities. Like, a RILA's got less protection on the downside, but a higher upside. So there's been a lot of innovation in this category around different, indexing methods and the term structure and a whole bunch of other things. I think at the end of the day, while there will continue to be a lot of innovation in that area, advisors and consumers need to make sure they're confident in the modeling of the whole thing. You need to understand what you're buying, and you also need to understand, sort of where this fits in the risk spectrum. We've done a lot of work with our career agents trying to highlight you still need equity solutions. You can't just live in this world of 4%, 5% returns. Inflation's at 8%. So you're losing 3% a year, basically, if you're in that world. And so I do think there will continue to be innovations in that space, but we've got to remember these categories are fixed alternatives. In the long run, a proper asset allocation does need to still have equity solutions in it.
Okay, great. Thank you. Todd G, somebody asked a follow-up. When you mentioned the $60 billion in sales, how much of that was replacement?
So we don't have an explicit replacement number yet. We're in collection with the insurance companies to calculate that for 2022. But what we have that kind of gives us signals is we can see the full surrenders of products on a quarterly basis. And to have a replacement, you have to have a surrender of an existing contract. So the surrenders in 2022, they only went up $8 billion in comparison, and sales were up $60 billion, which is a clear indicator that this money coming into the fixed rate deferred market is from outside sources. But with that, we do expect that replacements will increase as we move through the next 3 to 5 years. A lot of people think replacements are a 4-letter word. There's appropriate times when money can be moved from an annuity to an annuity itself as customers' needs change and whatnot. So even though we do anticipate it going up, it's just the natural cycle of the business that's been sold here over the past few years.
Great, thanks. That helps clarify. What is the forecast for life annuities with an enhancement for long-term care needs, i.e. the monthly income would increase when triggered by a long-term care event? I don't know who wants to take that one.
I can jump in quickly just with some industry information. We see products that have long-term care annuity combination products, we call them here. We see sales of those. They are minimal in comparison to the 300+ billion that we're seeing in overall individual annuity sales. Roughly around 500 million a year are being sold. There's not a lot of inventory out there. There's only a few companies that are focusing in on annuity LTC combination products at this point in time. But it is an area for opportunity, I think, for the industry as a whole, because obviously long-term care, all the stats around that, and the amount of people that are going to need some form of long-term care in the future is only going to grow.
Yeah, we write a lot about the need for long-term care and providing for it. Todd T., what does that look like from New York Life's point of view?
Yeah, no, I think you hit the nail on the head there, John. I mean, there are few, New York Life is one of them, insurers still left offering traditional long-term care insurance. There's not enough supply in the market probably to meet the demand. And I think that's what's led to a lot of the hybrid products. There's been a lot of success on the life side with the, kind of life LTC hybrid products. We don't have an offering in this category, largely for the reason that Todd mentioned, in the annuity LTC section, basically because there is no existing market today. But I will share, I've been asked this question more times in the last 6 months than I was, in the rest of my career. So I think that there is this sense that there's building demand out there for annuities to be able to offer some sort of LTC benefit. But we aren't yet participants in that space.
Okay, very good. Thank you. And Todd T., here's a follow-up to what you were saying about improved messaging of annuities and their value. Someone asked, what are 1 to 2 ways we as advisors and agents can improve and or drive this change? Can you talk about that a little bit?
Yeah, so I think I'll answer this at a high level, and then I can kind of use a couple examples. The first thing I'll mention is it's important for all of us to think about pre-retiree and retirement planning, not in relation to how we think economists are going to behave, but how everyday people are going to behave. And so I use this example of this guaranteed minimum accumulation benefit. I get a response all the time, hey, the market might not be down in 10 years, so what am I paying for? And my answer to that is nobody buys and holds, like practically no one. Like, I've got a degree in mathematics. I still trade in my 401k. It's stupid. I know it's a bad decision, but I do it because I'm a human. And so, one of the ways to do this is to make sure we're designing plans around how people actually behave. That I think is one point. The other is compared to alternatives. There's been a lot of complaints out there about the fees associated with annuities. Well, the fees are paying for a guarantee. And I'll use the example of a simple income annuity. We've been the market leader in this category for a long time, as simple as it gets. Put in $100,000, you get $7,000 a year for the rest of your life. Try to replicate that with bonds. You can't. It's not possible. Like there's no bond out there that if you plan to a reasonable time period, build a bond ladder, it's just annuity is a much more efficient way of generating that. So I think the simple story is, plan for how people are actually behaving, and then design a plan around that and show the peace of mind that an annuity can add as part of that portfolio. And the other one is compare the alternative. If you need to generate $2,000 or $3,000 a year, or $2,000 a month in income, Compare doing that with a portion of it involving an annuity and the rest doing a bond ladder. And you're going to like the response, you're going to, like the comparison if you've got that annuity in the mix.
Excellent, thank you. We have another question. How are SPIAs faring in the market? Todd G, do you want to take that?
Sure. So SPIA products, they had their challenges coming out of the pandemic. Ultra low interest rates brought the payouts down on single premium immediate annuities, and sales plummeted. What we saw in 2022 is it start to rebound pretty quickly. And in the fourth quarter, we actually saw record sales, and that continued into the first quarter of 2023, where we topped that by another $100 million. I believe we wrote $3.4 billion in the first quarter alone for single premium immediate annuities. I think there was a couple of dynamics. Obviously, payout rates rising. Our friends at Canix have a thing called pay index, and we saw rates that we haven't seen since 2008, 2009 in SPIAs. So the payouts are lucrative and attractive for individuals that are looking to layer on guaranteed income. I think the second dynamic is that we had a lot of individuals that were waiting to purchase an immediate annuity last year, because you had the Federal Reserve out there speaking about continuing to raise rates to combat inflation. So why buy today if I can wait 3 or 4 months and get a better payout? As rates peaked in the fourth quarter and then started coming down, I think that triggered some people to purchase at that point in time, locking in rates and driving the sales that we've seen here in the fourth quarter and into the first quarter of 2023.
Great, excellent. Let me ask, can you guys go over a couple of minutes if we answer a couple more questions? Yeah, okay, so regarding, here's a really interesting one. Todd T, this might be in your bailiwick. Regarding high interest rates for fixed annuities, do carriers have enough money in reserve to continue funding the fixed rate products going forward, or will they have to back off interest rates to slow sales?
Yeah, this is a really important question. I'm glad it was asked, especially in the context of, we saw a banking crisis a couple months ago. That was fundamentally a asset liability mismatch issue. A number of banks had demand deposits and long investments, which caused a lot of problems. People pull the money out, you're stuck with losses as rates rise on the rest of those assets, which fundamentally is what happened to SVB and a couple others. There's some very important distinctions on how those banks invested and how insurance companies invest. And I think the most fundamental of them, there's probably two. The most fundamental is, highly rated life insurers are going to invest with the same duration as what the liability is. So someone buys a 5-year FDA, we're not buying 30-year bonds. We're buying effectively 5-year bonds. I mean, I'm simplifying. So the upshot is we're pretty locked in. If we credit you 4% over those 5 years, we don't really care what happens to interest rates in the interim. We've got, liabilities that are assets that are backing those liabilities pretty much one for one. The other thing is, there's surrender charges on annuities. People don't like surrender charges, but that's how we offer that guarantee. We're able to match that investment to that term because we have a high degree of confidence people are going to hold it. And that's the thing with a fixed annuity is, person's basically agreeing like, I want this for a 5-year term. I don't want it for 6 months. And that's also a difference versus banking. If you've got your money in a savings account, you can pull it out anytime you want. You can pull it out of the annuity. It is liquid, but you're going to have to pay a surrender charge most of the time for it. So that's two reasons that, to the question, it really doesn't matter what happens to interest rates in the future. We'll be confident to be able to pay on that interest rate. If you're guaranteed for 5 years, we're going to pay for 5 years, and we have no problem with that. But it's also the reason that the annuity industry is materially less susceptible to any sort of, crisis like what happened to the banking industry. We just match our assets to our liabilities, and we're insulated if people need to pull out their money earlier.
Great, thank you. That's a really important answer, and thanks for going into the detail. Final question. It is the fees associated with variable annuities that companies have attacked and the non-guarantees. Now that there is a guarantee for a fee, variable annuities could have an effective story. But what is the effective story? Capturing every dollar of gain or versus the caps? I don't know who would like to take that. Todd T?
I can take a shot at it, and other Todd may interpret it in a different way.
Yeah.
As I mentioned earlier, I think, fees associated with annuities fundamentally pay for guarantees. One way or another, they're paying for a guarantee. And they're also, there's been a lot of this, that there's products now designed to have no explicit fee in the product. It's kind of an implicit fee. So again, use the example I mentioned, this guaranteed minimum accumulation benefit, guaranteed 10-year put option on the market. It's different than a RILA. A RILA doesn't have full downside protection. It's got a form of downside protection. But we have an explicit fee on that GMAB. A RILA has no explicit fee, but the implicit fee on the RILA is that you've got a cap on your return, which you do not have with our GMAB. So this I mentioned earlier. I think the way to analyze products is to look at sort of the range of outcomes. I mentioned this in the context of index annuities. Figure out, if you buy a 5-year index annuity, what's your return if you hit the cap 3 times and you hit the floor the other 2 times. See what that returns. That's really the way, and Canix and others have done a great job of kind of modeling this out and demonstrating. So the fee by itself isn't all that sort of interesting to me. It's really, what does the eventual return profile look like? So that's my interpretation of the question, but Todd may have read it in a completely different way.
No, I completely agree with that, Todd. When we look at annuity products, I look at it from a few different lenses. What is the value proposition to the investor, right? And when we think about annuities at a very high level, we'll fly the plane at 30,000 feet. We have protection, we have guaranteed income, and we have tax deferral as those options for investors that may need those solutions themselves. And then when you look across the different product types within annuities, it really is just a risk spectrum, right? We can buy a product, a fixed index, with or without a guaranteed living benefit. We can do that on RILAs, we can do that on VA. And then it comes down to, okay, where's my risk tolerance for the client? Like Todd mentioned, where does this fit in with the rest of the portfolio, right? Should we be more conservative with this asset? Should we be more aggressive with this asset because we have some guarantees on it? And that's really the value that the advisor can bring to the investor, is to help them find that solution with an annuity, where it fits in the portfolio and their risk tolerance itself.
Great. All right, John, I think that's all the questions that we have.
Yeah, it's a great session. I want to thank you, Todd Taylor and Todd Giesing, for sharing your precious time and insights with us today. John, why don't you close us out?
Yeah, thanks to everybody for attending, and thanks for all the great questions. Thanks to our great panelists. John Hilton, thank you too. We'll be sending out a link to the video from today's webinar soon. And please join us next month on July 12th at 1 p.m. as well for Cracking the Code, Attracting the Next Gen Client. So again, thanks to everybody today. Great session. Take care.
You guys.